The Art of Trading is a book by Henk Grundmeijer and Martijn Luijckx. This book is about the psychology of trading. The most successful traders are often mindset traders with a specific system. This system consists of a number of rules and the trader always obeys them. It may just as well happen that emotions arises, but it's never acted upon. So if the system sends out a long signal, the trader goes long, regardless of the news. Fear, hope, impatience and lack of discipline are often the causes of downfall. What often happens to starting traders is that they make an entry into the market, they determine a stop loss and a take profit, but then they mess around with it. They adjust the stop loss a bit lower because the price has come down, but the trader has full confidence that the market will rise, and it would be a shame so that, if things go wrong, the trade will eventually be closed with a loss. But now the trade will probably closes with much more loss than has been calculated in advance. Or the trader takes profit too early because the trade has fortunately returned to the green numbers. But then, at the end of the day, your lost trades are too expensive and your winning trades do not yield enough. So you see your assets shrink. First of all, choose a system. Which time frame are you going to act on? Do you work during the day or in the evening? And in what markets do you trade? Determine your trading strategy. Are you a breakout trader or do you use the moving average strategy? Whichever strategy you choose, stick to it. A very important rule is always to use a stop loss. Before you know it, the price shoots in an unexpected direction and your portfolio will be liquidated in the worst case. That's why you always have to determine where your stop loss will be and where you take your profit. Determine what your entry strategy is. When do you enter the market? Write down these rules on a piece of paper and hang them on your computer screen. These are your starting points. Then you look at your money management. About 90% of new traders run out of money within a year. For example, if you have 1,000 in your account, you may not lose more than 1% per trade, so 10 euros. For example, you can lose 100 trades before your money is lost. But the chance that that will happen is minimal. And the other very important tip is never trade with borrowed money. If you trade like this mechanically, you can also go to sleep at night with a good feeling. You don't have to stay up late or set your alarm clock in the middle of the night to check the charts. No, you know that your take profit and stop loss do the work for you and you can check in tomorrow. And in this way, you don't have to back up on your decisions. You don't have to lie awake at night because your trade is too far in the red. You know your stop loss is in place and you know that it is a calculated loss. You will not be liquidated. A trader with the right mindset accepts the risk he's taking and doesn't feel like a victim of the market. He doesn't get angry when things go wrong. He feels confident about his actions because he has a well-functioning system in which trades can go wrong, of course, but that remains perfectly manageable due to the chosen strategy. And he trades with money he can spare. And a very important aspect of being successful is patience. Don't rush into a market because the candles are green. Stick to your strategy, because trading without a clear strategy is the same as gambling in a casino, and you will not be profitable. Richard Dennis showed with his Turtle project that the key to the trader's treasury is discipline and consistency. In 1983 he had selected 23 people who had no experience in the financial market. He called them turtles because he started breeding traders the way they bred turtles in Singapore. He trained them a simple breakout trend trading system for 2 weeks. The trader receives a set of rules so that he no longer has to judge for himself, but he trades according to the rules, so very black and white. Each turtle was given 1 million to trade with, and after 5 years the turtles had made combined $175 million. But it was totally different when they started trading for themselves. Trading with someone else's money makes it easier to leave the emotion out. When it comes to our own money, emotions play a role, much more. Where do you get the motivation from when things go wrong? Determine your goals. Dare to dream and think about what it takes to get that far. Focusing on your goals every day will keep you motivated. It becomes difficult when the market turns against you. Sometimes it even happens several times in a row. If then undesirable behavior arises, so that you want to deviate from the rules, you could, for example, start looking for distraction. Also think in advance how you will deal with these difficult moments. In any case, do something other than keeping staring at the screen. But whatever you do, don't be angry with the rules. If you do this consistently, you will eventually start trading differently. You can trade with a discretionary system or a mechanical system. With a discretionary system, the trader's estimations play a role. The trader makes an interpretation of the support and resistance lines and patterns, and that is of course subjective. A mechanical trader has a set of objective rules. For example, if the EMA 20 indicator crosses the EMA 50 upwards, I will go long. Even under the most hectic circumstances, you are in control that way. The entry and exit are predetermined, and that will give you peace of mind. You have determined in advance which markets you will trade in, what your position size is, and what your entry is, and when you take profit and take loss. So the art of trading is to always stick to the rules. The character of a person cannot be changed, but the behavior can. So plan your trades and trade your plans. Good luck!